Happy Saturday out there, Team 42. It's your skipper here, Darius Dell, to present our Round the Horn for Saturday, August 24th, 2024. As always, we got a ton of macro web to chop through. But before we do that, if you're new to 42 Macro Research, we just want to say thank you. We appreciate you. Please take advantage of these resources to speed up your learning journey. We got a lot of high-end institutional content to get through every week, and we want to make sure no one's being left behind. So we'll start with our executive summary here on slide 4. This week's key macro question is, what is the bear case? Our answers are, in our August 3rd around the horn, we signaled the U.S. economy was unlikely to enter a recession over a medium-term time horizon. That view has since been confirmed by the data. In our August 10th around the horn, we signaled it was safe to buy the dip in risk assets. That view has since been confirmed by the markets. In our August 17th around the horn, we signaled stocks were likely to outperform bonds over a medium to long-term time horizon. So far, so good. Trending risk-off market regimes require either a sharp, surprising, and protracted slowdown in growth, a sharp, surprising, and protracted acceleration in inflation, or a sharp, surprising, and protracted tightening of monetary and/or fiscal policy, usually both. Neither outcome seems likely through year end. As such, we find it hard to articulate a defensible bear case at the current juncture. That implies the path of least resistance for risk assets remains higher through year end, especially in the context of our J wants a soft landing theme, which has undoubtedly helped 42 macro clients block out the incessant bear porn and participate in this bull market since early November. Asset markets may experience some pre-election volatility, but investors should prepare for another institutional performance chase into year-end. Recall that we correctly predicted last year's performance chase too. With respect to our KISS portfolio construction, no pivots this week. KISS is currently at 40% cash, 30% stocks, 30% fixed income, and 0% Bitcoin. So the following content is intent. So by the way, this week, I don't think we learned anything this week, by the way, from the perspective of asset markets or the economy. So we're just going to slow down and just kind of walk you through all of our quantitative risk management tools this week for those who may be new. So we want to make sure, everyone's, understanding exactly how we formulate the conclusions that we help investors, we use to help investors remain on the right side of market risk. But obviously, KISS and Dr. Mo are the main signals from the perspective of our process. So let's hop into it. So the following content is intended for use by retail investors and is not to be reconciled with our fundamental research views. If you guessed our KISS portfolio construction process, you guessed right. So in terms of KISS, for those who may be new, KISS is designed specifically to outperform the 60/40 portfolio, and it does that through three specific steps. So number one, factor selection, infusing alternatives into the portfolio construction instead of just having a standard 60/40 portfolio, reducing our overall maximum exposure to the fixed income asset class. We are structurally bearish on the fixed income asset class. Number two, the top-down risk management overlay. We use our market regime nowcasting process to incorporate volatility targeting into the strategy. And then from the perspective of our bottom-up risk management overlay, we use our VAMS signal to incorporate dynamic position sizing into the KISS portfolio construction strategy. And so those three elements are why KISS significantly outperforms 60/40 as indicated by this out-of-sample back test. The average annual return for KISS is 600 basis points higher than the average annual return for the 60/40 portfolio. And by the way, it's outperforming from the perspective of the risk metrics as well. And so KISS has a maximum drawdown of minus 12%. It's the only double-digit drawdown in this out-of-sample back test, which begins in January of 2018. That compares to a maximum drawdown of minus 22% for the 60/40 portfolio, which it has experienced twice in this out-of-sample back test. And then the maximum drawdown of if you were going to run 60/30/10 SPY Ag and Bitcoin without the benefit of these top-down and bottom-up risk management overlays, then you would have a very similar average annual return, but you would have a much worse experience as an investor with a max drawdown of minus 26%. And then you've also crashed twice since January 2018 in that if you were running 60/30/10 long SPY Ag and Bitcoin without those risk management overlays. So KISS does a phenomenal job of helping clients maximize upside capture in bull markets, and specifically retail investors, because I think this is a product specifically designed for retail investors to block out the noise and participate in bull markets, which obviously we've helped you do, really since January of last year. But so KISS does what it's supposed to do, and how KISS does what it's supposed to do. To me, I think Kalmar ratio is the average annual return divided by the max drawdown, and to me, any Kalmar ratio, not to me, generally speaking, across institutional finance, any Kalmar ratio north of 1 is fantastic. That's what you want. from a Kalmar ratio perspective. And obviously, we're much outperforming the 60-40 portfolio, or sorry, the 60-40 portfolio, and obviously SPY 60-30-10 SPY Bitcoin. So we're really proud of this system. If you're a retail investor listening to me talk right now and you're not following KISS, just know that you need to beat these numbers with all the decisions that you're making in your portfolio, trading this, trading that, longing this, shorting that, listening to this, listening to that, all the decisions that you're making as a retail investor. This is your hurdle that you need to beat if you're going to be making those decisions and not following KISS. So obviously, we continue to think that KISS is the best mousetrap out there to help you, sort of achieve your strategic investment objectives, which is, in my opinion, as a retail investor, should be, retire on time and comfortably. So this is our current KISS portfolio construction. As I mentioned, there are no changes this week. We're currently at 40% cash. I suspect by year end that'll be at zero. But that's our fundamental views. Our fundamental views are not infused into KISS. This is a systematic process that's obviously going to eventually respond to what we think are likely to be positive fundamental dynamics. But again, if we're wrong on that, systematic process will do a great job of managing risk for us. That's exactly what KISS is designed to do. So with respect to where we are currently, as I mentioned, we're at 40% cash. We're at 50% of our maximum exposure of 60% in the equity market. We're at 100% of our maximum exposure of 30% in the fixed income market. And we're currently at 0% of our maximum exposure of 10% in the crypto market. So with respect to how we get to those allocations, so USFR is our liquidity management instrument. Use whatever you want if you're going to be following KISS. In terms of how we get to the 30% position in SPY, the actual exposure is 50% of the target allocation of 60%. Target allocation is maxed out at 60% because we remain in a Goldilocks market regime from the perspective of KISS. It's Goldilocks with deflation characteristics. We'll talk about the with deflation characteristics when we get into the institutional portion of the program. But from the perspective of KISS, we're focusing on Goldilocks from the broad perspective of asset allocation. And then we're going to be focused on Goldilocks until further notice from the perspective of factor leadership, which is more of an institutional question to answer. So we're maxed out at 60% there, and the actual exposure is 50% of that because the SPY signal is neutral. That's the bottom-up risk management overlay working there. So that's how we get to that exposure. The actual exposure equals 100% of the target allocation of 30% in ag. The target allocation is maxed out at 30% because we're in a disinflationary market regime, and the actual exposure is 100% of that because we're bullish. And then finally, the actual exposure is 0% of the target allocation of 10% on Bitcoin. Target allocation is maxed out at 10% because we're in that Goldilocks, hybrid Goldilocks with deflation characteristics market regime, and the actual exposure is 0% of that because Bitcoin is bearish from the perspective of its volatility, just a momentum signal. So again, that's the bottom up and top down risk management overlays working together to produce the results you see here on the pie chart, which you should be implementing if you're going to be following KISS. So let's keep it moving here. The following content is intended for use by professional investors and is not to be reconciled with KISS. So as you know, with respect to our risk management process, what we are trying to do for you at all times here at 42 Macro, number one is help you identify and position for the market regime. That is how you make money as an investor. You acknowledge the market regime, what the market is trying to price in, and you participate. You don't tell the market what it's got to do. You don't guess what the market is going to do. You just do as the market is doing. Our jobs as investors is to be long the things that are going up in price and short and or down or out of the things that are going down in price. That's it. That's it. That if you simplify investing to that first principles, sort of framework, you will do a lot better than, infusing all this noise into your investment signaling process. If all you did was just stay long the things that are going up and short and or be out of the things that are going down, you will be one of the best investors in the world. So many our brains are hardwired to not do that well. And we talk about that all the time with respect to our common behavior heuristics analysis that we feature at the end of these presentations that I think everyone should spend, if you do one thing for me this week, print those out and read them, please. So at the end of the day, this is what we're trying to do is help you overcome those common behavior heuristics with this systematic process. So step one of that systematic process is identify and position for the market regime. And we know what that looks like from the perspective of the factor leadership that we should expect and the broad asset allocation that you should expect, the types of performance across assets you should expect. So, and then everything else we say is not designed to help you, to tell you what to do with your portfolio. Everything else we say is about helping you prepare for regime change. So you can anticipate regime change so that when regime change happens, you are aware and comfortable with the regime change so that you make the requisite pivots in your portfolio. But that's it. we're not trying to get you to, we're not trying to predict where the market's going to be on December 31st or June 30th of next year or December 31st of 2025. That's not our goal. Our goal is to give you the confidence that you need to make the changes when it's time to make the changes. And so that's how we help you prepare for regime change. We use our quantitative signals vis-a-vis our grid model, our macro weather model, positioning model, and our global liquidity model. And then we help you prepare for regime change using qualitative signals vis-a-vis our fundamental research views. So let's unpack those fundamental research views. So these are our themes, current themes in chronological order of when they were introduced to you. So our sticky inflation theme, which we introduced in January of 2022, we maintain medium conviction in that. U.S. inflation is unlikely to durably return to the Fed's stated 2% and de facto 2.5% targets in the absence of a recession. An inflation cycle upturn is likely over a 6 to 12-month time horizon. Inflation is likely bottomed and is likely to meander higher over the next year. We do not anticipate this outcome will be an issue for asset markets until sometime in the first half of next year. With respect to our resilient U.S. economy theme, which we authored in the summer of 2022, we maintain medium conviction in that. The U.S. economy remains resilient due to historically strong private sector balance sheets, the West Village Montauk effect, limited exposure to the policy rate, limited exposure to the more cyclical manufacturing sector, labor hoarding, and easy financial conditions. Low expectations suggest growth may surprise to the upside over the medium term. Growth is, however, likely to slow over the medium term due to waning fiscal support and retrenchment among low-income consumers and highly levered firms, which may contribute to an unwind of the labor hoarding phenomenon. With respect to our J wants a soft landing thing, which we authored in the beginning of November last year, we maintain high conviction in that. The Fed has an asymmetrically dovish reaction function that is geared towards engineering a soft landing in the U.S. economy. The Fed is implementing its typical fourth-turning playbook, which is to kowtow to fiscal dominance by artificially inflating demand for U.S. treasuries amid above-target inflation and explosive growth in federal debt. So let me say that again. They are artificially inflating demand for U.S. treasuries amid above-target inflation and explosive growth in federal debt. Is that bullish or bearish? Right now, the Fed is just, Jay Powell yesterday just told us he's going to cut the policy rate with inflation above target. If you knew that, if that was the only thing you knew as an investor, would that make you bullish or bearish? The Fed is cutting the policy rate with inflation above target. That's as bullish as it gets. What's bearish is when the Fed is tightening into a slowdown. That's 2022. 2024 is the Fed easing into a modest meandering lower of growth. That is definitely not bearish. So again, we're trying to find the bear. We're working hard to find the bear case. It was, and quite frankly, I'll be honest with you, when we do our macro scattering reports, what we try to do is help you understand what the modal outcomes of economic outcomes are from the perspective of our modal outcomes section, and then we layer on what we think could cause markets to surprise to the upside from a fundamental standpoint, and then we layer on what we think could cause markets to trend lower from a fundamental standpoint. And it was hard, producing the left tail risk section in the most recent macro scattering report. There's not a lot of bear stuff out there. There's a lot of bear porn out there for sure. That stuff will never go away. It just grows and grows and grows, and that's how people get clicks and subscribers in newsletters. But at the end of the day, that's not how you make money as an investor. You got to block that stuff out and have a first principles framework for approaching asset markets. And hopefully we're delivering that to you here with our systematic process. So appreciate you guys for tuning in. Getting back into this, our China front-loading stimulus thing, we maintain medium conviction in that. The Chinese authorities are likely to accelerate support of their economy with fiscal and monetary stimulus to counter the development of a structural debt deflation akin to 1990s Japan. A weaker U.S. dollar would enhance the PBOC's ability to implement aggressive monetary policies because it would reduce the risk of currency instability and destabilizing capital outflows. With respect to our green shoots globally thing, which we authored in January of this year, we maintain medium conviction in that. Improving leading indicators and/or persistently positive economic surprises are likely to catalyze positive revisions to growth expectations across the global economy over the medium term. A weaker U.S. dollar would increase both the supply and demand of cross-border financing, which would allow global growth to decouple from a slowing U.S. economy. Our Janet wants softer inflation theme, which we authored in April of this year. We maintain low conviction in that, which is the U.S. Treasury's net financing policy is getting less hawkish at the margins, dwindling bill supplies at being at least partially offset by declining coupon and bond supply. The fiscal impulse remains decidedly negative, however, and is likely to contribute to the pending slowdown in nominal economic growth. And so for those of you who want more insights onto how we derive these conclusions and the analysis supporting those conclusions, just check out our daily leadoff morning notes. The macro scouting report is the source of these conclusions. And then our daily leadoff morning notes is the Bayesian inference process that gets us from the prior macro scouting report to the next macro scouting report. That's kind of our whole investment. That's our entire, sort of business, really. It's okay. What do we think is going to happen from a perspective of a macro scouting report? Modal outcome, left tail risk, right tail risk section. The leadoff morning note is, okay, we learned something new today. How does this impact our previous views? We learned something new today. How does this impact our previous views? And then we report that to you on a weekly basis here in these around the horns. And then by the, after the next jobs report, then we update the next macro scouting report. It's a Bayesian inference process. We don't make stuff up. We're not constantly shifting our views and changing narratives. Everything we do here is incremental because we have a really a deep understanding of where we're coming from at all times, in my opinion. Understanding the base rate, understanding what is happening in financial markets and what is happening in the economy, as opposed to what people think is going to happen in financial markets, as opposed to what people think is going to happen in the economy. I think there's way too much emphasis placed on forecasting with respect to markets in the economy and not enough emphasis on respecting what is actually happening. And I think hopefully we're doing it elite level, or we're doing that at an elite level, in my opinion, or in our clients' opinion. We have clients around the global buy side that really appreciate what we're doing here. So hopefully you guys are appreciating that as well. So getting into our quantitative risk management summary, this is our, we'll start with our short-term signals, which tend to get resolved in a 1 month or less time horizon. Our crowding model is not currently generating any bearish or bullish signals. Our probable range model indicates that Bitcoin and commodity producers are overbought. Ethereum and Brent crude oil are nearly overbought. Further rallies from here would be a leading indicator of bearish to neutral VAMS phase transitions for each asset, which would be leading indicators of a return to a Goldilocks market regime. And for the reason I said that is because when our volatility adjusted momentum signal is quantitatively linked to the probable range. So when an asset is neutral VAMS, the probable range has a Gaussian distribution. When an asset is bullish VAMS, it has a positive skew in the distribution. And when the asset is bearish VAMS, it has a negative skew in the distribution. So essentially an asset that is bearish, that is grinding higher at the top end of its probable range, this tells you that it wants to go from this distribution to that distribution, which ultimately means that the VAMS signal wants to break out to neutral, the bare minimum. So keep an eye on that. If we see continued upside in things like commodities and crypto, those are obviously the highest beta risk assets. And so if the highest beta risk assets continue to rally, it's suggestive that we could be heading towards back into a Goldilocks, a real true Goldilocks market regime, as opposed to the hybrid market regime that we are currently in. So I will keep moving here. Short to medium term signals, which tend to get resolved in a 1 to 3 month time horizon. Our dispersion model indicates rotational flows have been balanced on a trending basis, indicating low risk of a sustained factor reversal. Our positioning model indicates short to medium term positioning indicators indicate retail traders overweight stocks, active managers are neutral stocks. And in totality, our positioning model indicates reasonable risk of a correction in risk assets over the short to medium term. The terminal Fed funds rate is currently the dominant driver of global liquidity. Floor Fed funds rate is currently the dominant driver of the US dollar. Real bond yields are currently the dominant driver of the RRP. The terminal Fed funds rate is currently the dominant driver of the S&P 500. Structural inflation expectations are currently the dominant driver of Bitcoin, and structural growth expectations are currently the dominant driver of gold. With respect to our volatility adjusted momentum signal, among the 4 horsemen of market risk, the VVIX fixed ratio is neutral, the high beta low beta ratio is bearish, small cap mega cap ratio is bearish, and the value to growth ratio is neutral. Risk assets are mixed, stocks are neutral, crypto is bearish, commodities are mixed, defensive assets are mixed, CVIX, MOVE Index, VIX, and US dollar index are neutral, gold and treasury bonds are bullish. With respect to our medium to long-term signals, which tend to get resolved in a 3 to 12 month plus time horizon, our global macro risk matrix indicates Goldilocks with deflation characteristics is the hybrid market regime. To reduce the frequency of market regime phase transitions amid elevated indecision across macro markets, Goldilocks with deflation characteristics will remain the hybrid market regime until the strength of signal associated with any one regime ascends past 50%. Goldilocks with deflation characteristics means investors should position for Goldilocks asset allocation terms, which is essentially how many stocks versus how many bonds, how much cash, etc. And then for deflation in portfolio construction terms, which is what type of stocks, what type of bonds, the factor leadership you're expecting. Again, that's more of an institutional question, so be aware of that. With respect to our global liquidity monitor, key leading indicators of global liquidity imply a slight decrease over the medium term, so that's not great. With respect to our grid model, deflation is the modal outcome from a bottom-up macro regime perspective in the U.S. economy over the next 3 to 6 months. Inflation is the modal outcome from a bottom-up macro regime perspective in the U.S. economy over the next 6 to 12 months. With respect to our macro weather model, that's currently generating a bullish 3-month outlook for bonds in the US dollar, a neutral 3-month outlook for stocks, commodities, and Bitcoin. And the composite signal for Bitcoin deteriorated due to a phase transition in the consensus next 12-month unemployment rate delta component feature, which is now expecting no change. The composite signals currently indicate a reasonable probability of transitioning to a sustained risk-on market regime over the next 3 months. And then finally, with respect to our positioning model, the medium to long-term positioning indicators indicate investment advisors are overweight stocks, neutral bonds, and underweight cash. Speculators are underweight stocks, underweight treasuries, neutral to US dollar, and underweight commodities. Systematic funds are neutral stocks. Market neutral hedge funds are overweight risk assets from a gross exposure perspective. Risk asset valuations are currently consistent with major bull market peaks. In totality, our positioning model indicates reasonable risk of a crash in risk assets over the medium to long term. And when we say things like reasonable, moderate, low, high, all those things are just qualitative assessments based on quantitative thresholds being met across the indicators in our positioning model, our macro weather model, et cetera. So just be aware of that. And then finally, if you're new, anytime we highlight something in either of these summaries, the fundamental research summary or the quantitative risk management summary, it just means that there is a material change in that signal or in that theme from the preceding 42 macro research report. So it helps train your eye. So you don't have to read the whole thing every time. You can just focus on what's changing at the margins, in the context of our Bayesian inference process. So getting into our global macro matrix, we use this to now cast the market regime, which investors must position for to avoid FOMO or getting blown up. The one thing I call out, just particularly on this slide, is that we went from we had a bearish to neutral VAMS phase transition in the 10-year Japanese government bond yield. Recall that Bank of Japan Governor Kazuo Ueda testified to Japanese Parliament yesterday, and the key takeaway was that they're going to continue on with policy normalization, which is exactly what we've been calling for. If you look at the dynamics in Japanese economy that are likely to contribute to potential upside surprise in the speed with which they normalize policy, you have our grid model for Japan is projecting accelerating growth over the medium term. It's projecting stable, sticky inflation above the Bank of Japan's 2% target over the medium term, and then ultimately wage dynamics in the Japanese economy, which Kazuo Ueda is using as their North Star. Though the Japanese wage growth accelerated to the fastest rate we've seen since 1997 in the most recent data point. So you have a lot of dynamics in Japan that are contributing to a likely upside surprise with respect to the speed and overall distance of Bank of Japan policy normalization. So that's obviously not great. We could have some negative outcomes in asset markets as a function of that. The next Bank of Japan meeting is on September 20th, right after 2 days after the Fed meeting. Fed cuts rates on September 18th. So they may not do anything on September 20th because I think there's going to be a parliamentary election there, or a preliminary election, sort of in October in Japan. But you should expect the Bank of Japan to continue on with policy normalization between now and year end, and that could cause some consternation in asset markets. But again, from the perspective of everything we know today with respect to our fundamental views in terms of trying to help you anticipate how the market regime is likely to evolve, it's suggestive that that'd be a viable dip if we do get some more consternation from an unwind of the yen carry trade. So keeping it moving here. So as I mentioned, the global macro with respect to we're in this Goldilocks with deflation characteristics hybrid market regime. Deflation is currently the regime with the highest number of signal now, but again, the strength of signal continues to be unusually low. Has been unusually low for the past couple of months, and because I think the asset markets are really trying to debate where are we headed from here. Asset markets are they're appropriately skittish because we're at the top of the sine curve from a growth perspective here in the U.S. economy, looking down, and so they're nervous about that. But again, we don't believe that the slope of the deceleration is going to cause problems. The consensus thinks the slope of the deceleration may cause problems, but we ultimately think growth is likely to surprise to the upside throughout the second half of this year. We've been consistent on that. So that's something that we would expect to continue to see, confirmed by the data. With respect to CAC rate continues to rise below the consensus complacency threshold. Perhaps we'll be breaching that by the end of the year. Who knows? I don't want to make predictions. We don't want to predict the predictors, but at the end of the day, this has historically been a big risk off signal. So let's say by mid to late November or mid to late December, we're breaching the consensus complacency threshold. Right around the time our model suggests inflation will start to materially diverge to the upside from consensus expectations, you could have a significant risk off moment in asset markets in the first half of next year. So again, but we don't want to predict that. That's sort of our general baseline expectation, and we'll continue to update you if that changes. So keep it moving here. Investors may use our discretionary risk management overlay, aka Dr. Mo, to implement a customized version of KISS, or as a market timing and position sizing guide for factor long short bets. So if you are a sophisticated retail investor or an investment advisor, you're implementing KISS, some version of KISS for your clients. Obviously, 60-30 10 SPY Bitcoin may not get you paid if you're managing client money. So you could diversify into different exposures using this tool here. So again, we're focusing on Goldilocks from the perspective of the asset allocation. So in terms of that'll guide your top-down risk management overlay pivots, and then the VAM signals for each of these assets will guide your bottom-up risk management overlay exposure. So you can, for those of you who want to implement a customized version of KISS, say you don't like SPY, you want Qs, you don't like Bitcoin, you want gold, whatever floats your boat, just review our KISS FAQ for more insights on how to properly customize into KISS. But the reason this table exists is really not to do that. It's really just a market timing and position sizing guide, factor long short bets for our professional investor friends and our sophisticated retail investor clients. And all you need from this table in that regard are the proper trade recommendations. You literally don't need anything else. Just look at what the proper Dr. Mo is recommending or prescribing as a proper trade for each of these assets at any given time and implement that. You don't have to think. Slide 18 will tell you everything you need to know about 42 macro research in one snapshot. That this is the most valuable thing we've produced. KISS and Dr. Mo are by a country mile the two most valuable things that we produce in terms of keeping our clients on the right side of market risk. So that's why when we go back to this slide, identify a position for the market regime. The global macro risk matrix identifies the market regime, and then KISS and Dr. Mo help you position for the market regime. And obviously KISS is a simplistic way to position for the market regime, but Dr. Mo is the non-simple way for the professional investors who are relying on our signals. And so, for those of you who may need some insights on how this works, Dr. Mo is designed to do is merge the interplay between the top-down versus the market regime and the volatile adjusted momentum signal into a different proper trade recommendation. So if an asset is bullish, and it should be bullish in this regime, then Dr. Mo will recommend a long max position in that asset. If an asset is neutral, but it should be bullish in this regime, Dr. Mo will recommend a long half position in that asset. If an asset is neutral and it should be bearish in this regime, then Dr. Mo will recommend a short half position in that asset. And if an asset is bearish and it should be bearish in this regime, then Dr. Mo will recommend a short max position. And if an asset is bearish and it should be bullish, then Dr. Mo will recommend a no position. If an asset is bullish and it should be bearish, then Dr. Mo will recommend a no position in that. So that's exactly how it works. And so, all you have to do is just implement what Dr. Mo is telling you across each of these assets. And you don't have to change your position until Dr. Mo changes the proper trade recommendation, which could come either via volatility adjusted momentum signal phase transition in the underlying asset, or it could come with a top-down risk management, top-down market regime pivot in the overall market regime. And so, as again, we expect this Goldilocks with deflation characteristics hybrid market regime to get resolved in favor of Goldilocks. We think Goldilocks will win that arm wrestling debate, but it hasn't yet. So just be aware of that. So until it does that, we're going to continue to roll with this. But again, we're not too far off from a strength of signal that's getting past that threshold that we identified back in June to get you to pivot into one of these full regimes. But until we get there, I think I don't know if the coast is fully clear yet, especially in the context of our positioning model signaling that there's a reasonable risk of a correction over a short to medium term time horizon. So hopefully everyone understands that. Let's keep moving here. And so these are the back tests for our VAMS signal and our Dr. Mo signal. You can see the full back test here on slide 2022. But for those of you who may be new, just know that if you're following our VAMS signal for stocks or crypto, you have a 96% and 98% upside capture ratio, respectively, when our VAMS signal is bullish for those assets. If you're following our market regime nowcasting process for stocks or crypto, you have a 97% and 109% upside capture ratio in those assets. And again, that works. The strength of those tools is very optimized for every market. And with respect to the VAMS signal is optimized for every market, and then the market regime nowcasting process, with respect to feeding into Dr. Mo, is optimized for every asset. So Dr. Mo knows exactly how the asset should trade in the regime, and then if the VAMS signal is confirming of that, then Dr. Mo will say, yeah, high five, be along that with max position, and vice versa, all the way down through the proper trade logic, which is again described down here at the bottom of the page. So let's keep moving here. Getting into our VAMS and probable range models, the dollar still neutral. Gold, dollar still neutral. It looks like it wants to break down to bearish. Recall that we've been fundamentally bearish on the U.S. dollar, and that's obviously coming to fruition here in recent weeks. Gold remains bullish. The 2-year nominal treasury yield and the 10-year nominal treasury yield both remain bearish. The S&P 500 remains neutral. VIX remains neutral. NASDAQ remains neutral. Plus 2000 remains neutral. Bitcoin and Ethereum both remain bearish. As I mentioned earlier, they're kind of hugging they're starting to hug the upper boundary of their probable range signal, which could be a leading indicator of a neutral VAMS phase transition in those assets. And of course, if we had a neutral VAMS phase transition in those assets, then Dr. Mo will go from a current no position to a long half position. And then obviously KISS will take up exposure from 0% in Bitcoin. Keep it moving here. Commodity producers are bearish currently, but again, looking like they want to break it back out to at least neutral. Brent crude oil is bearish currently. And then ag and industrial commodities have both recently broke out to neutral as well. In terms of our 4 horsemen of market risk, The VAMS ratio is neutral. The high beta, low beta ratio is bearish. Small cap, mega cap ratio is bearish. Value to growth ratio is neutral. In terms of our crowding model, we use this to generate tactical trading opportunities in asset markets. And how you get a bearish signal is the underlying asset's overbought and investors are chasing local highs. How you get a bullish signal, the underlying asset is oversold, investors are puking local lows. Neither of those conditions are being met currently, so let's keep moving. In terms of our dispersion model, we use this to identify extremes and rotational flows between sectors and factors within the stock market. As you can kind of see here, there's no extreme. Extreme would be a positive flows into cyclicals would be a +2 sigma type reading. -2 sigma type reading would be a sort of extreme flows into defensives, and nothing's happening right now. So there's low risk of a sustained factor reversal at this current juncture. We're seeing a lot of defensive sort of factors kind of lead the market higher here, and that's consistent with where we've been, right? All that we pivoted to Goldilocks with deflation characteristics back in late June, suggesting that, hey, we do think that the broader, we think the general trend in asset markets is likely to be higher, but until we break into a high conviction Goldilocks or reflation market regime, we're expecting that the defensive should lead because, again, we're at the top of the growth sine curve looking down and growth is slowing. So if deflation is the modal outcome from a bottom-up macro regime perspective in the U.S. economy over the next 3 to 6 months, that would suggest that defensives could lead, but they could be leading in the context of a bull market. What would cause cyclicals to lead is if we're right on the view that the growth is likely to surprise to the upside, persistently surprise to the upside over the medium term. And if that is the case, then you have to see consensus growth expectations and consensus earnings expectations get positively revised higher throughout that process. That's how you could create a Goldilocks market regime, a high conviction Goldilocks market regime, and that will cause the market to broaden back out into cyclicals. So that's something that could be on the horizon, by the way. So just be aware of that. So I think that's something that, again, markets will figure that out and resolve that in the course of the coming weeks. With respect to our positioning model, we use this to assess the probability of significant reversals in momentum across asset markets over multiple time horizons. One thing I call out is that the AI bulls bear spread is now back up in the 89th percentile. It's currently exceeding the median, the 75th percentile reading that has historically been observed at these major bull market peaks. We don't have the NAAIM stock allocation survey that quite at high yet, but it may be by the time we're having this conversation next week. So just be aware of that, the correction from these types of levels, especially in the context of the seasonality we tend to see in September, that's something that could be a risk. But again, we still think from a fundamental standpoint, that would be a viable dip. So for anyone who didn't get a chance to buy the dip going back a few weeks ago when we said it was safe to buy the dip, or for anyone that just hasn't been participating in this, raging bull market that we called for back in early November of last year, if you haven't had an opportunity to participate in those things, I would suggest that from a fundamental standpoint, you should be buying whatever dip is likely to come on the horizon in the coming weeks, if not the coming months, because again, there's likely to be another institutional performance chase into year end. Whenever you have positioning light into a rally, you tend to have squeezes into year end, and that's not always the case, but it's certainly a high probability outcome, and we were correct calling for that outcome last year. Keeping it moving in terms of the drivers of these various main macro market indicators. So global liquidity, terminal Fed funds rate continues to be the dominant driver of global liquidity. Floor Fed funds rate continues to be the dominant driver of the U.S. dollar. The real bond yields continue to be the dominant driver of the first repo facility, and we nailed that back. Going back to I would say in June or May or June, we determined that the model said real bond yields were the dominant driver of the RRP, and we saw as soon as bond yields started to decline significantly, investors got scared that they were going to miss their ability to lock in interest rates in the bond market, and they start flowing funds out of the RRP to chase the rally in bonds. It wasn't to buy the dip in stocks; it was to chase the rally in bonds. So be aware of that. That's what the excess liquidity that's currently in the RRP. It's waiting for an opportunity to lock in those yields, and obviously Jay Powell just gave us the 2 thumbs up on that from the perspective of reducing the duration risk in the bond market. For now, we think there will be duration risk in the first half of next year, but again, that's not something markets have to price in anytime soon. With respect to our terminal Fed funds rate, continues to be the dominant driver of the S&P 500. The structural inflation expectations are now the dominant driver of Bitcoin, and then finally, structural growth expectations are currently the dominant driver of gold. With respect to our macro method model, we use this to assess the probability of regime change in asset markets over a short to medium term time horizon. With respect to unpacking the principal components of macro, we'll start with the real economy cycles here on the left. Real GDP is currently trending sideways. It's expected to inflect and trend lower by 130 basis points over the next 12 months. Headline CPI is currently trending lower. It's expected to continue trending lower by 60 basis points over the next 12 months. The unemployment rate is currently trending higher. It's expected to stay at that level over the next 12 months. The implied sales growth rate for the S&P 500 is trending higher. The implied earnings growth rate for the S&P 500 is trending higher. The implied, the sovereign fiscal balance to nominal GDP ratio is trending higher. That means the budget deficit is getting smaller as a share of GDP. The US dollar real effective exchange rate is trending higher. This is due to our financial economy cycles. So that's the rising real effective exchange rate for the dollar is consistent with a tightening of fiscal policy and getting into our liquidity, getting into our financial economy cycles. 42 macro net liquidity, that's Fed balance sheet minus TGA and RRP, which is everybody's net liquidity model now. That's trending lower. Our global liquidity proxy, which is the aggregated sum of the global central bank balance sheets from the major economies in the world, their broad money supply and their FX reserves minus gold with the bond market volatility overlay to account for the fluctuations in the repo market. That metric is trending higher, so that's obviously positive. Domestic credit growth and global credit growth are currently trending lower. Benchmark policy rate is currently trending sideways. It's expected to the 2-year nominal yield spread relative to the benchmark policy rate is pricing in a significant degree of rate cuts, and that's getting the amount of rate cuts that are being priced in is widening, as indicated by that negative trend in that metric. And with respect to positioning on the fear side, the investors are extreme short the dollar, they're neutral on treasuries, and on the green side, investors are extreme short commodities and neutral on stocks. So each of these component features contributes independently to each of these asset classes. And so currently the composite signals for the stock market and Bitcoin, commodities and Bitcoin are neutral, which means investors should expect baseline type returns, which are positive for each of those asset classes over the next 3 months. Investors should expect above baseline returns for the bond market US dollar over the next 3 months. And so, this is a very important tool in terms of help. One, again, going back to what we talked about earlier, we want to know what's happening at all times. You hear so much stuff with respect to where is the market headed, where is the economy headed. When you listen to podcasts, you listen to, you scroll Twitter, you read investment research. It's all about where we headed. There is a tremendous amount of signal in knowing where you are. That's exactly what the backtest of the macro weather model proves, is that there is information on a forward-looking perspective just from the existing trends in the data. The existing trends in the data have information from a forward-looking perspective. I don't know that most investors realize that. In fact, I would argue most investors don't realize that. They've been conditioned to assume that markets are quote unquote forward-looking and they're always focused on the future. And that is true, but the best investors in the world understand where we are today from a base rate perspective, and they're assessing and updating their probabilities about what's happening in the future from a Bayesian standpoint. You can't be Bayesian if you don't know where you are at any given time, and that's what the macro weather model does a great job of, is helping investors know exactly where they are at any given time. Another model that we use to help investors know exactly where they are at any given time is our grid model, which we use to assess the probability of regime change in asset markets over a medium to long-term time horizon. So the macro weather model gives us a good, it's like a flashlight. Think about investing as you're walking with permanent uncertainty as an investor. That's part of taking risk is part of the job, right? You can't, if it was guaranteed returns, then the returns will be low. And that's exactly what you see. The returns are generally low for things that have guaranteed returns. And so if you want to take risk in financial markets, you can sort of do that in 2 ways. And we try to do that. We try to help you understand how the market regime is likely to evolve in 2 ways. One, with the macro weather model shining a light into the future. 2, with our positioning model, trying to say, okay, there's extremes in positioning that should cause a reversal in market momentum. 3, with our global liquidity model, in terms of trying to help investors understand where liquidity is likely headed. And then finally, with our grid model, in terms of helping investors understand where growth and inflation are headed, because those are historically been a big dominant driver of how the market regime has evolved. So getting into our projections here. So deflation remains the modal outcome from 3 to 6 month perspective on the U.S. economy, at least according to our model. That's consistent with consensus as well. Inflation remains the modal outcome from the perspective of our model with respect to the 6 to 12 month time horizon. That's a bit different from consensus, which is calling for mostly Ds and some Gs starting in the first half of next year. So where I see a lot more market risk developing is in the first half of next year. If we're right on inflation and consensus is expecting Goldilocks, that will cause problems in asset markets. And so, particularly from a level, if we rally in the year end like we suspect we will, then that will be, our positioning model might be beat red from the perspective of the indicators flashing elevated risk of a correction and or crash on risk assets from that perspective. So that's kind of our general baseline. If it changes, if our general baseline changes, we will tell you. But from now, based on everything we think we know today, that's our general baseline of how things are going to play out. So as I mentioned earlier, growth is likely to surprise consensus expectations to the upside over the medium term. Inflation is still trending down, but eventually in the first half of next year, you'll start to get some divergence with respect to consensus and moving in the wrong direction from the perspective of all the interest rate cuts that are priced into the 2025 Fed funds futures and OIS curve. So that could come out and cause some consternation in the bond market, which could cause some consternation in asset markets from the perspective of valuations and liquidity. But again, we don't have to price that in now. Still think things are relatively sanguine. Getting into our global gear models, the modal outcome for the world is Goldilocks through year end. So just be aware of that. That's upside surprise risk. We talked about that this week in the lead-off morning note. And then finally, our global liquidity monitor. We use this to nowcast global economic developments and forecast geographic dispersion across asset markets. A lot of information in this table, but in terms of the primary information you're going to want to look at in this table are the systematic trade ideas. So on the stock side and the long side of stocks, what you're looking for in a systematic trade idea is the growth, the consensus general growth expectation is trending higher, and you have positive economic surprises that are they're pulling those expectations higher. And so that's, in terms of how we get to that general growth expectation, that's the blend of the current year and next year forecast among consensus. And so consensus is essentially saying positive economic surprises are catalyzing positive revisions to consensus growth expectations, which is obviously bullish for equities and credit. And so currently UK satisfies that condition. That's no longer the case for Canada and the US, which had negative systematic trade ideas. So that's positive at the margins. The consensus general growth expectation for the U.S. economy is back to rising again, and that's exactly what we called for, a few months ago when we said, hey, growth is likely to surprise to the upside over the medium term. Consensus is too negative on growth in the second half of the year, and again, that this continues and we get back into a trend of positive economic surprises, the systematic trade idea is likely to have an up arrow for the U.S. in the coming weeks and months. So just be aware of that. And then in terms of how we get to bullish systematic trade ideas for bonds, the consensus general inflation expectation is trending lower, and the economy has negative inflation surprises that are catalyzing negative revisions to consensus inflation expectations. And so that's just be aware of that. And so again, those consensus general inflation expectations are the blend of the current year and next year. It's a general expectation. Okay, when market participants are like, okay, what is the U.S. economy, a 2% economy or 3% economy? Is the Chinese economy a 5% economy or 4% economy? That's the general expectation based on the current year and next year blend. So that's how we get to bullish bond market signals. A bearish bond market signal is obviously the opposite. You have general inflation expectations rising and positive inflation surprises catalyzing positive revisions in those metrics. And then finally, with respect to systematic trade ideas for the FX market, a negative systematic trade idea for a currency is you have a falling consensus nominal GDP expectation with the policy rate that is declining. And so that's obviously the case in China. We've been right as rain on the Chinese yuan this year. The bearish development in the U.S. dollars, particularly if it breaks down to bearish VAMS, you're going to get an all clear signal from the perspective of the PBOC to start stepping on the gas again, which I would argue, or the data would argue, they definitely need to do to stave off a structural debt deflation. And maybe they don't. Maybe they understand that it's futile anyway, and why dump more monetary stimulus into an economy that's already oversaturated with liquidity. But again, I don't know if they have a choice. You can either have a 1990s Japan debt deflation, China, talking to you, Beijing, or you can do something about it. So I assume with human beings in control, the Politburo, they're going to continue to do something, perhaps do something in a more accelerated fashion in the coming months based on the breakdown and the dollar. So we'll wrap it up. Without wrapping up there, in terms of forecasting global liquidity. So we, as you know, we do everything we do here is based on proven quantitative techniques. And what we found is in terms of identifying things that lead global liquidity, particularly the fluctuations in the 42 macro global liquidity proxy. It's the stocks, it's crypto, it's dollar, it's FX volatility, it's interest rates, it's fixed income volatility, it's growth, inflation, and unemployment. Those are the leading indicators for global liquidity. And those leading indicators are currently aligned in a way that suggests we might get a slight decrease on global liquidity over the medium term. And how we determine that, so we take the correlation adjusted Z-score. So these are the correlations on a 3-month lead and a 6-month lead for these particular indicators. And then these are the Z-scores on a trailing 3-year and trailing 10-year basis. And we adjust we take the Z-score of those indicators and we adjust them from the perspective of the correlations. And then we subtract the overall sum of that math. So we just sum them all up together and we subtract that from the Z-score of the year-over-year rate of change of the global liquidity proxy. And if the indicators are currently aligned that says liquidity should be higher, i.e. we have a positive value in this chart, then we would anticipate a slight increase or significant increase in global liquidity depending on how much the excess is. And right now, if the excess is negative, we anticipate a slight increase or decrease slight decrease in global liquidity. And right now, they're currently aligned in a way that suggests we might get a slight decrease in global liquidity over the medium term. So that's not good. So if we are going to have a positive resolution to this Goldilocks with deflation characteristics hybrid market regime in favor of Goldilocks, then we would expect these things to evolve in a way that suggests we're going to get a slight increase or a significant increase in global liquidity over the medium term. So I don't want to get in trouble for predicting the predictors here, but just be aware that our fundamental research views, and we'll wrap it up on this, fundamental research views are not designed to tell you what to do in your portfolio. again, going back to the discussion at the beginning of this discussion, our fundamental research views are designed to help you anticipate how the market regime is likely to evolve so that when it changes, you are comfortable making the appropriate changes in your portfolio. That's it. We're trying to help you build conviction so that you're not surprised by a phase transition in the market regime. That'd be the worst thing. If we built a system that told you, hey, well, I do know a guy that has built a system, or I wouldn't call it a system, but I know a guy that does this, and I'm sure a lot of you know him as well. Hey, we're in a new regime. Well, how? How do we get there? If you're not going to make the appropriate changes in your portfolio, if you don't have the confidence to make those changes. And so that's why we talk about where growth's headed, where inflation's headed, where liquidity's headed, where positioning is. That's why we talk about those things. But it's not designed to get you to do something in your portfolio. The only thing we tell clients to do in their portfolio are two things: KISS or Dr. Mo. That's it. That's it. So if you're listening to me talk and interpreting me talk and interpreting the words and the charts on these pages, and you're doing something in your portfolio that is not aligned with KISS or Dr. Mo, that's fine. You're welcome to do that. You can use our research however you want, and we appreciate you for being a client, but just know that that's not the intended use. The intended use is to help you respond to Bayesian observations, not to tell you what to do based on some failed prediction or some prediction of the economy or any of those other factors. So be aware of that. And then finally, we'll wrap it up with our common behavior heuristics that prevent investors from achieving their strategic investment objectives. Please, if you're new to 42 Macro Research, your homework assignment this week is printing this out and reading every single one of these. I think investors should probably read this, once a month. Generally speaking, you have to control your fast brain, your emotional brain. We talked, Danny Kahneman and Amos Tversky talked, reported extensively about how our brains are hardwired as investors to cause us to make mistakes. It's just, we have so many cognitive biases as human beings that cause us to make investment mistakes. And so how we have approached that here at 42 Macro is we built in actual guardrails in our process that are specifically designed to eliminate those cognitive biases. For example, let's use one. What's a good one? What's a good one for today? Here we go. Negativity bias. The negativity bias, based on all the bear porn, recession bear porn, and doom porn that we got over the past, month or so, the negativity bias and the unwind, the blow up of the Japanese yen carry trade and all, it was clockwork. The bear porn people got so many new subscribers in their newsletters at the beginning of August, and guess what? Those people are going to be canceling those newsletters at some point in the next calendar year because they didn't make any money in financial markets. And those people will probably be 42 Macro clients in the next 6 to 12 months. And we're grateful for that. But the negativity bias is a cognitive bias that results in adverse events having more significant impact on our psychological state than positive events. And so how we do this in terms of how we've sort of built guardrails in our process to avoid that is we avoid bear porn at all costs, even to the point of ridiculing it publicly. Asset markets tend to appreciate over time, so our general disposition towards asset markets is long until a risk management signal instructs us to book gains. That's it. You want to be long assets, particularly as a retail investor. If you're an institutional investor, your job is to pick factors long and short. And obviously, I can't think of a better tool than our discretionary risk management overlay to help clients pick factors long and short in terms of sizing and timing. So we'll wrap it up there. Thanks for reviewing. We'll catch you back here next week. Cheers.